I guess that's the debate, Jim. How can the economy hold up in the face of what Fed Chair Powell is doing and what is ahead of us, and how much is reflected in the market?
Well, I think if the Fed is bent on inverting the funds to 10-year yield curve, then, you know, the odds really go up on a recession at that point. I really think the Fed, the case for tightening, Sarah, is fading away rapidly. I think real growth is slow, very sluggish, maybe 1.5%. And as you say and been talking, I think inflation's coming down very rapidly. And there's enough tightening policy already in the pipe, from slow money growth, slower fiscal stimulus, a big rise in the dollar, big rise in yields, that's going to continue to push downward force on inflation well into next spring, I think. So I really think the Fed's going to be done after about another 50 or 75 here myself, overall. And I do think the economy is in a lot better shape than we think compared to past cycles, primarily because balance sheets are so much stronger than they used to be. The debt-to-income ratio in the household sector hasn't been this low since 1990. Net worths are really strong. Cash levels, liquidity are ample everywhere. And the corporate sector looks about as good. Housing's getting hit really hard, and mortgage spreads are recession-like levels, but the corporate junk spreads are not. They're not signaling a recession. And I think that reflects the fact that corporate America is in really good shape. So I guess we will weather this, although we're going to grow very sluggishly in the coming year.
Meghan, what about you? Do you agree with that? I would say somewhat rosy view, because in that assumption you make, Jim, it's that inflation comes down quickly, the Fed pauses as growth slows, but we escape sort of the worst of the recession. Meghan, is that something you buy into?
Yeah, well, I think what the market got a lot of juice from through the summer was the idea that we would reach a peak Fed funds rate south of 4% and then actually start to move lower. And that is, I don't think, a risk that the Fed is willing to take. We do expect inflation to come down pretty dramatically. The tricky part is that even a year out, we see the CPI on a year-over-year basis at around 3, maybe a little bit north of 3%. And that is not the Fed's target. So as we look at inflationary forces going forward, the housing market is definitely encouraging. The tricky part there is that we tend to see the housing market play into the CPI with a lag of anywhere from 12 to 18 months, which is incredibly long. And I think the market's gotten a lot of support as well. And there, I think there's some upside risks. If you think about OPEC not willing to let oil prices stay too low, China's propensity to relax their COVID policy after a very important party Congress. So we just have to watch there. And then you mentioned early in the segment the progress that Ukraine is making, and that just raises risks for the weaponization of energy by Putin. So I think there's risks out there. We're not willing to stick our neck out and add to equities here, but we are fully allocated. And I think the reason behind that is that it is really hard to get back in, and all it will take really for the market to find a bottom is 1 or 2 really encouraging CPI reports potentially. And if we're looking at a recession next year, then we could have a little bit of a rally into the end of the year.